I'm just going to turn on my video just for now because my internet's being a bit funny today. But nice to meet you all. And as Violet said, I've actually worked with her before, and I'm really excited to share what Ndovu does, why we do it, and how we give everyday Kenyans access to financial markets, not just locally, but also globally. I know for Violet, all of you have been through training, so you really understand the financial lingo, jargon. I'll try not to use any of it, but if there's something that's unclear, feel free to put it in the chat and I will answer it. And I'm also going to pitch this not to super layman, because I understand you already have done the training, so I want to make sure this session is super useful to you. And yeah, I'm really excited to be here. So I'm just going to share my screen now and I'll turn off my video. Pleasure to meet you all. Can you see my, wrong one, apologies. Can you see my screen?
Yes.
Yes. Brilliant. So a bit of background about myself. So I'm Kenyan born and raised, but I have over 15 years of experience in financial markets. I was a investment consultant at Deloitte, advising large institutions and pension schemes on how to invest. And then I moved over to BlackRock, where I spent 10 years working with, again, large corporations, looking at every type of strategy you can think of in terms of different asset classes, so equities, bonds, and property, and infrastructure in the world, but also looking at different ways of investing. And through that, really learned that actually investing is really about investing for the long term. So that's not timing the market, but really thinking about building your wealth across a period of time, trying to achieve financial goals, which are things like saving for your children's education, building a home, going traveling perhaps, doing anything that you want. But really, how do we take and build something that allows the everyday Kenyan African to actually start doing that? And that's how Ndovu was born. There's 3 of us in the founding team, and I'm one of them. And Violet covered what we're going to cover today. And yes, please feel free to put anything in the chat and I'll try and answer it as and when it's appropriate. So I'm just going to quickly take you back to the financial basics. The ideal, these are rule of thumbs, things that you can always, you've probably heard it before, but you can come back to over and over again. Your first thing is that you should look to save 25% of your income. Again, if you can save more, that's great. Some months you'll save less. But we know that saving is not enough because we have inflation, the cost of living is constantly going up. But when you're saving that money, you should be thinking about investing it. And the way we like to see it, we break it into 3 portfolios. Emergency fund, which is it's in the name. It's something that you can quickly access should there be an emergency in your family or in your personal life. So you've lost your job, someone's fallen ill, someone needs an emergency loan. This again, like I said, easily accessible, should sit in your savings account and or a money market fund, because you want to make sure this capital is safe and secure. And then we look at the opportunistic fund. So this is a super high risk fund where you're willing to lose the capital that you've invested. So things like lending a friend some money to start a business is super high risk. Buying individual equities is, we see it as high risk depending on your level of knowledge around financial. But for example, holding one particular stock like Safaricom or Apple or Tesla can be quite risky because there's a lot of volatility, and I'll talk about it in a minute. And also investing in crypto, for example, or a farming project, that's seen as opportunistic. And then today, that what we're going to focus on, and the ethos of Ndovu really is long-term investing. And we really believe that long-term investing is about taking your time to build something over time, so investing regularly towards your goals. And the way we do it at Ndovu is through exchange traded funds, which is an ETF. And simply put is, you guys are probably very familiar with unit trusts and mutual funds. It does exactly what a unit trust or a mutual fund does. It's a basket of stocks in one particular fund. It's just that it's more tax efficient, it's easily tradable, and it's cheaper to invest in. So the fees that they charge you are significantly lower. And at Ndovu, we're very much focused on investing through ETFs, and I'll explain why. And here in brackets is roughly how much you should, in your overall assets portfolio, be allocating to each of these portfolios. So 5% to emergency, give or take, 20% to high risk opportunistic fund, and 75% to your overall. And again, these vary depending on how comfortable you are with investing. So it's just a rule of thumb that you can always follow. So why is saving not enough? So just generally, African countries have high rates of inflation. The average has, over the last 5 years, has been 5%. So, holding your money in in our account is not doing anything because the savings rate is about 2 to 3%. We need to do more than that. We work hard for our money. So how do we make our money work hard for us? And that's when smart investing comes into place. And the key benefit of long-term investing is this magical thing, well, two magical things, one called the compounding effect, which I'm sure you're all familiar with, and secondly is time. So let's just take a quick example here. We are saying that, okay, say at the end of our lifetime, when we come to retire, we would like to have 10 million shillings invested or saved up so that we can make sure we are able to continue to live the life that we like. If you started investing, if you started saving essentially at the age of 55, you would actually need 130,000 shillings every single month. And say you decided to do that when you were 45, actually that comes down significantly and starts to feel more manageable at 36,000 shillings. But if you start when you're super young, you got, let's say you're looking to retire at 65, that's 30 years, you only actually need 12,000 shillings. And the reason is because of two things. So compounding effect simply means that the money that you invest earns interest, and then that interest compounds and you earn money on the interest, and so on and so forth. I hope that's clear. But essentially, it just means that you're getting more money by investing early, and that's why it brings down your initial requirement significantly. And of course, time is a benefit. If you look at, so whilst I was at BlackRock, we have different types of funds. We have the passive funds, which are funds whereby are ETFs essentially, whereby you just buy a fund to track the market. And then you have active funds, where there's a whole team that sits and their daily job is to look at which stocks to pick every single day that are going to drive or return a significant value. If you look at generally at the funds that are passive funds, they have outperformed active funds over a 10-year period. And they are cheaper because passive funds, you're just tracking the index, so you don't need a full team. So the costs are much lower. So you're only paying low fees. And they actually have performed better than active picking. And this is why also at Ndovu, we really focus on investing in a fund rather than stock picking. And the reason is, firstly, we don't think you have enough time as a retail investor to research companies that you think are going to be significantly. So for example, and I'll move back. For example, I don't think even myself included, have enough time to understand how we think Tesla is going to perform in the next 10 to 15 years. And therefore actually investing in a sector is much better than actually investing in a particular stock like Tesla. So that particular sector would be technology. And I'll talk a little bit later of different sectors and how to really select what you think would do well. So just introduction to Ndovu. Our vision really is to help people use their hard-earned money to actually invest it so they can continue to grow and achieve financial freedom in whatever sense that might be to you. And the reason we would say Ndovu is the platform for you is, firstly, we actually give you great investment advice, and I'm going to do a demo and I'll show you how. Secondly, we not only give you access to local markets, but global markets as well, which is really important because our Kenya shilling is pegged to the US dollar, which means that, all of us on the phone are probably on a smartphone or a laptop that is internationally manufactured. We use products that are international. Just more generally, we eat things that are international. Our consumption is international. And, eventually when you go on holiday, you send your children to study, it's all international. So it's really important to invest in the currency in which you eventually will be spending. And of course, USD is stronger in terms of its strength, so it also retains its value. So it's nice to have a balance. And at Ndovu, we actually recommend investing your portfolio 40-60 Kenya shillings to to USD, because in Kenya, you actually get really good returns on low risk investments such as bonds, fixed deposits, money market funds, in comparison to the equivalent in the US market. So, you know, a fixed deposit in the US is not going to give you the same amount of return, even when it's converted back to Kenya, and also Kenya shillings. And also because we're living and spending and still in Kenya, and you know, it is our country and we want to grow it, it's very important to also invest. Whereas the other 60%, we recommend investing in global, as that gives you a bit of a hedge should anything happen, such as things like the upcoming election, any you know, volatility in terms of taxes going up locally because of cost of living going up, etc. Things like that is good to hedge your hard-earned money, essentially. And also lastly, we're quite competitive in the market. We'd like to say we're competitive. So our fees are much lower, and I'll talk about it a bit later. It's not important. But yeah, so how does Ndovu work? So I'm going to pause there in case there's any questions. I'm just going to change my screen in the meantime. Just one moment. There we go. Oops. There we go. There we go. So now I'm just going to take you through our dashboard, because it's much easier to explain more financial stuff and how it works whilst you're using a dashboard. So keep in mind, this is a demo one. Yeah, it's a dummy one. So please, yeah, keep in mind. So one of the key values we think Ndovu brings to the everyday Kenyan is that sometimes we don't know how to assess what type of risk we should be running in our portfolio. The reason is because sometimes we think that we're more risk seeking, but our lifestyle might say that we are more risk averse. So at the beginning, when you first sign up, we ask you a series of questions to really understand what is your ability, your personal ability to take risk. So we take you through a series of questions, and I'm just answering these randomly for now. You know, what are you investing for? So nothing specific. How much money do you earn? All this information is obviously confidential, and it's actually helps us understand how much risk you should be running. So what happens, how long would your cash saving last you in case of a shock? A shock could be anything like a pandemic, job loss, you're ill, you know, and etc. So we take you all the way to the end, and there are a few questions. I think it's the bar up here shows there's only 3 or 4. So, you know, real estate bonds, I'm familiar with everything. And what's my attitude towards risk? You know, what would I do, and what am I looking for? In the end, there's one more question. I would invest more, sorry. In the end, based on the answers that you've given us, we tell you what type of investor you are. The way I answered, I knew it would be adventurous because I've been doing this for a really long time. But this means that, you know, you have capacity to run a little bit more risk in your portfolio based on your lifestyle and your level of understanding in terms of education. And that's really what we initially do. It's all digital. We have algorithms in the back end that really say, Violet, you are a balanced investor based on your actual lifestyle, rather than her thinking she is aggressive and she's willing to take more risk. So this is an initial guidance that comes up. But once you sign up, we really have 2 types of investing. So one is general investing, and one is goal-based. Goal-based is very much for individuals who who don't want to come back every single day or every other day to look at their portfolio. They really just want us to get on with it. And general is for people who have a little bit more experience and hands-on, and they want to select their investments by themselves. I personally recommend doing more general, because I think you learn more, and it's really important to understand a little bit more about markets. And you guys are all learners on this phone call, because I know you guys have done the actual education. So let's go through this first, and then I'll go through the goal-based depending on time. But essentially what we have done here is, you can imagine that outside in that universe, there's about 2,000 ETFs. We have taken the time, using our financial expertise between our team, we have over 36 years of financial understanding, to say, okay, of the market that's out there, what funds should we bring to our users, and why should we bring them? So we put them through a risk and compliance process. But So what we've done is we've actually selected a whole range of funds that would be useful. But the reason we recommend investing through ETFs is because we really believe that, well, firstly, historic performance has shown us that investing through a pool of funds and a fund itself outperforms active picking. And secondly, it's just more cost effective in terms of being in terms of actually not high volume trading, not paying too much fees because ETFs are cheaper. And lastly, because we think when you invest, you should be investing for the long term. It's really hard to time the market. And what really matters is time spent in the market. So, there will be volatility. Like, for example, markets are down at the moment. A, because people expect a recession. B, there's the whole Ukraine and Russia war going on. And C, there's been a lot of inflation in the market. And that's why markets are currently there's a bit of volatility. But that volatility is short-lived. And if you look at a chart historically, you'll see that the S&P 500 has continuously to grow upwards. And maybe I can just pull up a Yahoo chart to show this. Just there you go, S&P 500. Oops, there we are. Wonderful. So Max. So let's just say we believe that investing in the overall market, such as an index such as S&P 500, you'll always see your wealth grow, even though as you see on this chart, there's slight volatility, there's ups and downs, but the idea really is to focus on investing for the long term. So just going back here, what we've tried to do is simplify global funds for you. And this is a blue chip fund here. It's US denominated, and the risk level we say here is cautious. The reason we say it's cautious is because when we were building the platform, we really focused on a sector. Well, we focused on picking sector funds as well as a thematic fund. So this is more of an overall market fund, which is the S&P 500. So when you invest in this fund, we're not putting all our eggs in one basket. We're diversifying our risk by actually saying that we think that the overall market will continue to do well. So if you invested in the blue chip fund, this is the S&P 500, and you get access to a whole range, 500 companies to be specific. Microsoft, Facebook, Alphabet, MasterCard, Coca-Cola is an example of them. And we show you here, and please ignore the year one performance, how this fund has performed over time. So, the first year one performance still carries on from the pandemic. There's a lot of people at home, and it was a simple supply and demand. People were at home, they were worried about their finances, so they started putting a lot of money into the stock market. There was over $1.3 trillion that went in that year. And obviously, if there's more money chasing the same companies, you're going to get a very solid return. So this is not a good metric. But the way you look at how a fund performs is to look at the longer periods, 3-year, 5-year, and 10-year period. So on average, if you were to have invested your money, not on average, but if you had to invest your money 5 years ago, your money would have grown every year by 16.25%. But please note, past performance is not a guide for future performance, but it helps you understand the ability of the fund manager, the institution that's managing your money, to see how they're performing over time. And we give you details here of the fund manager here is BlackRock, and the underlying fund is the S&P 500. And because you're all learners here, you can also actually go through the prospectus and the fund fact sheet if you wish. And so I'm just going to pull up the fund fact sheet here. It basically gives you details of how this fund would have performed should you have invested $10,000 in 2000. That $10,000 would have grown to around $50,000 now. And yes, that is around 20 years ago. And this is why we say investing is for the long term. So this you can read it in your spare time. It tells you, the underlying fees, the top sectors it's in. They have the top 10 holdings over here. And that's essentially one example of an ETF. So when it comes to selecting, this is great. There's about 20 funds here, and you may ask me, okay, how would I select a fund? I don't have, I've done a lot of research, but I'm still not sure. One thing I always say to all my, all the users that I speak to is that because investing is for the long term, there's a lot of information out there, and it's really hard for us to say, okay, I think Coca-Cola is going to continuously perform and put all my eggs in one basket. Instead, we say, what sector do you think is going to be around for 10 to 15 years that's going to continuously innovate and disrupt the market and is going to be needed by the overall world population? So let's look at healthcare as an example. Healthcare is a necessity, not a luxury. Given the pandemics just showed us that actually healthcare is a sector that will continue to boom. There's always innovation in this sector. These are the companies that sit there. They're in the news regularly for good things, maybe perhaps, some bad things from time to time. But we know that this sector will be around. We can comfortably, and making an informed decision, say that this sector will be around in 10 to 15 years. So this would be, in my eyes, a good fund to hold more generally. And then you can have a look at, again, the fact sheet and the performance of each of these funds. And then the second way I would pick a fund is to say, okay, what am I passionate about? Forgive me, I don't know what Violet, what her career is, but let's say, for example, she is a coder and she codes video games, for example. There's a video game fund here that you can actually invest in. You can also invest in the techie fund that has all the funds that are all the companies that have something to do with technology. Let's say somebody else on the call here is a property developer or does real estate. We have a real estate fund here as well that is all the companies that essentially have anything to do with real estate. And this particular fund also, I say, is a very good diversifier in your overall portfolio. Because real estate, even though this is an equity real estate fund, real estate performs differently to, let's say, the S&P 500 because the underlying metrics are different. Brick and mortar is always seen as a safe haven. And now markets are changing a little, you'll see real estate perform better than the equity funds itself. We also have commodities such as gold, which have now recently gone up, have done really well because of the uncertainty, with the upcoming potential recession, and the war that's going on at the moment. And we have a whole range of different funds here that you can go through and say, okay, I think the China. So right now, actually a good tip is that the Chinese companies are selling at a discount. So that means the value of these companies have come down. And that's because of several things. COVID is really bad in their region right now. There was a real estate large company there that went into administration, and then the government had to come in and bail them out, which basically gave the overall outside market shivers in the sense of, oh, maybe that's not a sector right now. But the way I see it is that China is a 1 billion population. Even though they're currently selling at a discount, it's a good market. And I do see China continuing to outperform more generally over the next 5 to 6 years for a minimum. So that's like an interesting fund to see. So this is simply, this option really is you go in, you do your research, you pick a few funds. I always recommend doing this. Because I feel that you're then more in tune with the news and you're just more keen to learn about different types of sectors and funds in here. For the team, for some of you who might be interested in a little bit more riskier fund, this is Kings of Blockchain. So it's not a crypto fund, but it's blockchain is the infrastructure on which crypto is traded. It's currently all the craze now. So we've seen a lot of people invest. You can see the returns relatively high, but again, it's a volatile fund. So it shouldn't make up all your investment. It should hold maybe 5 to 10%, depending on your risk appetite, of course. But yeah, I wouldn't have all your investments in there. So that's one user journey that we have here. Is there any questions around the markets, ETFs versus stock picking that I can answer? You can unmute your mic, feel free to ask away, or you can put it in the chat. And whilst you do that, and don't be shy, whilst you do that, I will go to the other user journey in the meantime. Nope, nothing in the chat, okay. Yeah, so goal-based investments is simply put, you tell us what you need to, you tell us the amount of money that you would like to have at the end of a certain period, and we make sure we pick the funds in order to ensure you achieve that goal. And with the goal based. We do this based on the risk level that you're given at the beginning. So again, it's bespoke. So there could be a conservative investor where we take very little risk, and then there would be an aggressive investor where we take a lot more risk. So I'll just take you through an example. So let's say we're saving for a car, and in 5 years' time, so just at the bottom, we want to buy a car that's 10 million shillings. It's quite a fancy car, clearly. It's 10 million shillings, a lot of money. But, we've worked really hard in our careers and we're doing really well. And, you want to treat yourself. So we're looking to achieve a target amount of 10 million shillings, and I'll change that to Kenya shillings. And here we will say, okay, today I say I have 100,000 shillings saved today. And I think I can comfortably invest 20,000 or save and invest 20,000 shillings every single month. So that goes to show that actually that is not enough in terms of our target, and 20,000 shillings is not going to help us get to our target in 5 years' time. And just here, there's adventurous or balance. So you can see that the target of amount changes as you change the risk that you take in your portfolio. So of course, if you're conservative, you're going to have less amount of money because they generate less return. And then as you move across, it increases the amount of money that you have. Again, if you were to change your risk level, it sort of tells you here, you've changed your risk level. Are you sure you want to continue given you were given a different risk level? So yeah, just something to think about. But essentially here, the way I see this is fine. We want to get to 10 million shillings over a 5-year period. There's a couple of things that we could do. We can try and save a little bit more every single month, or put a little bit more towards this goal. So you can break down goals in different multiples, or you can look to invest or save for a little bit longer. So here, okay, from our 5-year goal, we're saying, actually, I'll be comfortable if I get this to 7 years. Now, an interesting thing is that as we continue to grow over the 7-year period, the amount of money that you'll be able to save will change. We hope that, all the hard work we do at work means we are able to change jobs or get a promotion. So the amount of money that you're saving on a monthly does change. So keeping that in mind, it's interesting to have a play around to see, okay, can I achieve that goal over time? So the money that you would be saving in year 1 will be significantly different in the amount that you would be saving in year 10 or year 7, for example. So we sort of go here and we say, okay, right, at the end of this, for your goal of your car, we know you want it in 2029. This is how we would invest your money. So, we would look at 70% would be held in equity funds. 16% will be in cash. So this is fixed deposit, money markets, and government bonds. The equity funds are all ETFs, and they vary in the risk level, and we look at it on a monthly basis. And then bonds, of course, are local bonds, US denominated bonds, UK denominated bonds, as well as local infrastructure as well. And we will say, okay, based on this, we will work towards making sure we deliver your goal target of 4.5. And then as and when you've invested, etc. Here we show you, we give you, we'll say, okay, these are your targets. Where did the car goal go? Maybe I didn't create it, but that's fine. We show you how much total money invested, what's your current, and how much profit you have made over time. And then here we'll say what you can expect from a yearly return. For the balanced fund is 12.69%. And then if there's adventurous, I believe it's around 15%. And then if it's conservative, it's anywhere between 9 to 10%. So that's the second user journey that we have on the platform. And that's really our thinking behind it. Now, I'm gonna just stop sharing my screen and go back to the presentation and just sort of give you a little bit more context on how we think about keeping our customers' money safe, the security we have on our platform. Okay. Right. So first and foremost, my other co-founder is called Rogito. He was the head of strategy at the Nairobi Securities Exchange. And both of us come from well, BlackRock is known for their risk management, number one, but we both come from a financial background where we understand the importance of keeping our customers' money safe from the get-go in terms of, how do we manage your money? So one thing that we've done is we use custodians to make sure that your funds are kept separate from our operational account. So the user journey of the flow of the money very much is you put money onto the platform. The money that you invest goes and sits with a custodian, which is a third party. We have one locally and one globally. And then that custodian, we then in the back end go and place your trades. The custodian then takes the cash that they have got from our users and sends it to buy the funds. And then that cash is turned into assets. And the custodian has a record, not by name, but by a client ID number of saying, Violet has bought 5,000 shillings worth of an S&P 500. And now that asset sits in a custodian. So should there be an event whereby Ndovu is, something happens to us, your money is kept separate from us, and the CMA, the Capital Markets Authority, as well as the custodian will come together to say, client ID X, Violet, contact details, this has this much, and they'll contact you to say, okay, what would you want to do? Do you want to go to another broker, or would you like to sell this investment? This is a model that is followed across all financial institutions locally and globally. So say, there's been some companies that have gone bust in Kenya. You can get in touch with the Capital Markets Authority and they'll direct you in how they're managing that particular process. It is lengthy. It does take around 6 months, but just to let you know, that is something that you can ask for as a underlying retail investor. We are regulated by the Capital Markets Authority locally. The broker that we use is Interactive Brokers, and they're regulated by the FCA, FINRA, and the SEC in the States. And also all the fund managers locally and globally that we put onto our platform, we take them through a risk and compliance process to understand, are they doing what they say on the tin? Do they have the right risk and governance processes in place to make sure our user money is held and safe? Recently, we took a local fund manager off our books. I won't mention who it is because we believe that their portfolio manager, so the individual that manages your money and makes the investment decision, they had a turnover of 2 over 6 months. So there was somebody left, they came in, left in 6 months, and the other person came in, left in 6 months. Now that doesn't give us confidence. There's clearly some internal issues that we're not aware of. Why is there so much turnover, especially in such a critical position? So that's the value that Ndovu adds. We look at all our funds and fund managers on a regular basis to make sure we're comfortable. Okay, and yeah, this is just the team, and I will pause there because I don't have anything else to share. Violet, back over to you. I guess we'll open the room for questions.
Yes, I think this is a Q&A session. Maybe I'll go fast before the rest of the team goes ahead to ask their own questions. I wanted to know, what is the intersection between investing based on my risk appetite, that is whether I'm an adventurous investor vis-a-vis my goals? What is the balance there?
What is the balance there? Great question. So the initial risk profile that we take you through is to give us an understanding on how much risk you in your personal lifestyle can take. So when you create a goal, we first will always show you how much you can achieve based on the profile that you're given. So that will either be conservative, balanced, or aggressive. And that will give us guidance on saying, okay, for this particular user, we will not take more risk than this unless you give us consent whereby, and I'm just going to share my screen again for the goal, just to show you. Unless you give us consent when creating a goal, by changing the dial to say, actually, for this particular goal, I want to move to more of an aggressive strategy. So because we are not having face-to-face conversations with you, the risk profile makes sure that we don't run too much risk in your portfolio for your goal, because now we have a bit more information on you. So it's not a one-to-one financial planning session, but we know that actually based on our algorithm, this is the type of investor you are. So that gives us an indication of how much risk we should run in your portfolio.
Okay, thank you. Any other question?
Hey,
Hi, Rhoda.
hey, how are you?
I'm well, thank you. Yourself?
I'm good, thank you. So my question is regarding the risk, the type of risk in terms of an investor as far as conservative, balanced, and adventurous is concerned. So I recognize that if when you're the more adventurous, the more risk you're able to take, the higher the risk of losing your money.
Correct.
And of course the higher the interest that you'd get. So I'm just trying to understand from the examples that you've given, how that balances out, or how I'll be able to understand the kind of risk that I'm taking in terms of the amount of money that I'm investing. So for instance, if I am an adventurous investor, so if I put in $10,000, and whatever investment I make loses money, so does that mean that I will lose my capital or part of the capital, or does that mean I'll lose part of what I had made?
Good question. So firstly, when we invest our money, there's always risk associated to money. That means you can lose the principal, so the money that you put in, the 10,000 shillings in this example, because that's the nature of investing. And without taking risk, you won't make a return, and it's not a guaranteed product, but there is a guaranteed products on there. So we also offer the infrastructure bond whenever it opens. The cash funds that you're looking at are also, it's very likely for you to lose your the capital that you put in. And some bond funds on there, again, bond funds are most bond funds here are guaranteed, but there still is a risk. So this is just for general knowledge. When it comes to investing in equities, you're taking risk. And what we have done here, because we believe in building wealth over time, and because we're investing through ETFs, what you're doing is you're bringing down the risk at which you're going to lose your principal amount. And the reason is because you're not putting all your eggs in one basket by betting on a particular company or saying, I think Safaricom is going to be around for 10 years. You're actually having an informed decision about the telco industry going to do really well. So there is a risk, and if you invest in an equity ETF, you can lose your money, but it won't be your entire $10,000. The markets will go up and down over time. And so you will see, that you've lost, maybe, if you checked your portfolio today, because markets have come down, you've lost it, but that's not to say that you're going to lose your money over time. And that's why we always educate our users to say that investing is for the long term, and you will see ups and downs in your portfolio value. But when the markets have come down, it's really difficult to do, but it's to train your mind to say, okay, if it's a sector I believe, like technology, the markets have come down, it's selling at a discount rather than saying, I'm losing money. And what you do is you tend to invest slowly over time. So every month you would put in, I wouldn't recommend doing $10,000 at once, because it makes sense to break that down at 1,000 a week, for example. I know it's a bit of hard work, but that means that you're actually getting a balanced price when you move into the market. But yes, you will see the value of your portfolio go up and down, but over the longer term period, that's 3, 5, 7 years, your money will appreciate. So yeah, I hope that answers your question.
Yeah, it does. Then the other question I had was about your fees.
Yes. Yeah, sure. Go ahead.
How does that look like?
So we charge a platform fee depending. So we have 2 tiers. We have a basic tier where you pay 1%, and that 1% is taken up front. So if you put in 1,000 bob, we would take 1 bob up front. And then if you sign up to our premium, your fees comes down to 0.75% per annum, which is again taken up front, but you also get access to a financial advisor. That one is, so again, if you invested 1,000 bob, you'd be paying 75 cents, whatever that is in 75 cents rather than a bob.
So the difference is that with the basic tier, it's just the platform. You don't get access to
Financial.
a financial advisor. So if you take the premium, so the financial advisor is available to you whenever you need, or is it at select times?
So over the years, you have 2 sessions. So firstly is an introduction session to make a financial plan that's suitable to you. And then we give you a follow-up saying, these are what we think you could invest in. And then we have a check-in call to say, this is how your portfolio is doing. Has anything changed in terms of your financial situation? If so, these are the things that you should consider. And the financial session is it's not just about investing. It also talks about wills, life insurance, health insurance, what's the best type of insurance product to buy. So that's, so it's a full financial planning session, not just investments.
Okay. Oh, and the 1% charge is, so for instance, like you mentioned, if I'm putting in money every week, so it's for every single deposit I make.
Correct.
I get just 1%. Okay.
Yeah. Eventually, we will move to charging the fee every single month, but we're still building that process in the back end. So it won't be an upfront fee. But essentially, just for now, because it's ease of simplicity, it just is better this way for now. And then just to give you a comparison, there's other providers that give you access to global markets. They take 2% upfront, they take 1.5% up. So we'd like to say we're quite competitive. And then just to be clear, we're very transparent in our fees. So when you go through the user journey, we actually tell you how much is being charged. So actually I can just show you so invest. Can you see my screen? Yeah, you can.
Yeah.
So general investing, let's just pick a random fund. Top up. So I would say I'd do $50 in USD for this fund. And then here you can pick your payment method. We use a payments provider to actually, if you wanted to use your card, but it comes at an additional cost. So I wouldn't recommend using this. It's easier in terms of user journey, meaning it's all done on the platform. I would actually recommend doing the bank transfer, because when you do it with a bank transfer, the fees is like 200 bob, which is minimal from your back end. And here we tell you, okay, you're looking to invest $50 USD dollars. The transaction fee is 0. How much will Ndovu charge you is 38 cents. So we're quite transparent, and there's also more information on our FAQ, and then you just follow the user journey. So here it's saying, okay, then you have to go off the platform, go to your bank and do the transfer using these details. And once you've done that, you press I have transferred money, and then you confirm the payment. This is a cheaper way to do it. If you're investing in local, if I just go back, if you're investing in Kenya shillings, you can also use M-Pesa. Okay, not USD, Kenya shillings. And then you can use M-Pesa, but here we'll convert your Kenya shillings into USD, and the FX rate we use is just the one that we get from the bank. So they have their commissions, etc. But yeah, again, we're quite transparent. So we tell you how much you're paying in fees, essentially, just here.
Okay, thank you.
Brilliant. And then I'm just going to have a look at the chat box, because okay, so I believe we've answered the first question. And if you have anything more clarifications, feel free to unmute your mic. So facilitation fees is that either 1% or the 0.75%, either or, depending on your plan. So it says, does the blockchain portfolio include NFTs? No, it does not include NFTs. The blockchain portfolio includes companies that provide blockchain. So they don't, in short. And the second question is, can I withdraw from the investments at any time? And is there any fees? So yes, you can withdraw anytime. So the way the investment process works is, say Anthony came onto our platform and invested 5,000 shillings into a fund. It takes 3 working days for your trade to be reflected. We say 3 working days, normally it's done in a day. And the reason being is that the market are not open in the daytime in Kenya. They only open from 5 p.m. because we're trading on the US market. So the trade gets placed and gets settled, and we get a confirmation the following day. But it takes 3 business days for the full cycle. And it's the same for a withdrawal. So again, you go onto a platform, you say, click withdraw, we'll get the trade, and then we place the trade once the market is open. And then we get a price to say, okay, this is the number, this is how much the value is, and then we return it to your bank account. So that whole process can take 3 working days. In terms of withdrawal fee, yes, we have a $5 withdrawal fee for now, because what we were finding was that people were using our platform as a trading platform, which is not what we are. So the cost of us actually having to withdraw someone who's using it as a trading platform is $5. So that's what it is today. Hopefully, when we get a lot of flow, that will go away and there shouldn't be a withdrawal charge. So there is a withdrawal charge. And then, do we have a minimum that one would need to start with? Yes, the minimum is 5,000 bob for investing. Investing anything lower than that just for now doesn't make any sense in terms of the costs associated with trading. So that's why it's 5,000 shillings. I hope I've answered everyone's questions.
I see someone's hand is up. Yes, David, you can go ahead.
Yes, hello. I have a question with regards to the premium pricing. So when does the one-on-one advice come in? Do I need to make an appointment for that to happen, or does that happen automatically when one invests with that option?
Yeah, sure. So I've just pulled up our website, and these are the 2 plans that we recommend. So this is what you get essentially for the basic. It's $50, etc. Here we say a minimum of 1,000, but because we haven't really stuck to it actually. But you get a one-on-one planning session. So our support team will get in touch with you as soon as you upgrade to ask when you're free. We set up a Calendly one-on-one. I'm still talking to customers today because I think it's really important to understand, what are your challenges, etc. We have other financial advisors on the team as well. So it'll either be me or someone else. And then when your 6 months comes into play, our team automatically will reach out to actually set up a call. If you want to call earlier, you just get in touch with us on support@ndovu.co. We really have built this company on two pillars. One is investment experience, and the second one is customer experience. Investment experience is making sure we keep your money safe, we pick the right funds, make sure you're generating returns. But the customer experience is really everything from the UX, UI of the solution all the way to customer support. So we aim to get back to you within 24 hours of you reaching out to us. And again, we're very, very much contactable during office hours. So there is somebody, tending phones, etc. So I hope that answers your question, David.
Yes, it does. So I guess I think I'll be reaching out to your team then through your email, so that maybe I can get that appointment. My second question was on is it possible to have both goal-based investing and general investing in one account?
Yes, it is. On the goal-based, you can create as many goals as you want. And just to take a step back on creating goals. Let's say, David, you have a daughter. I'm just taking an example, and she is currently 8 years old. She's going to graduate and go to university, and you have 10 years to save for her education. So you can work backwards and say, okay, say she wants to go to Harvard, I don't know, UPenn, or maybe an English university. We know the fees in total for the entire time she's there for 3 years is around $200,000. and you need to start saving towards that. So you work backwards and say, you put it in the goal thing. Okay, I need $200,000. See how much you need to save, say every single month. So that gives you an idea today how much you need to carve out. But let's just say your daughter decides, you know what, I'm an excellent singer and I don't actually want to go to university for 4 years. I'm going to go do a vocal course elsewhere, and it's only a year. It's going to cost you less. So that money eventually you can repurpose. You can say, okay, my daughter doesn't want to do that, but luckily I've got now 100K that I can go and use for something else in my life, essentially. So the financial plan is very much your plan, and things change. But the thing is, you're saving towards something, so you can always repurpose your money.
Okay.
Yeah. Great, David. Here we go. So we've got one here is, how many funds would you recommend for one to invest in? Okay, so if you're doing goal-based investment, the underlying funds that we hold are 3. We don't like to complicate things. If we see a particular fund that's doing more, we will add it eventually. But for now, we don't want to complicate things. Sorry. When you're looking at a general investing, I always say start with 3 funds. So like you saw on there, there's a overall fund, which is S&P 500 and MSCI World. That's the blue chip or the world famous. That's really great to hold. And then I'd say go back to your principle of which sector do I think is going to be around in 10 to 15 years? And then do I want to add a diversifier in my portfolio? So the diversifiers is either a money market fund, which is on there known as Salama, gold fund, the real estate fund I mentioned. And actually sometimes you can add a fourth fund if you're wanting to take a little bit more risk. So that could be the Futuristic, which is a Kathy Woods fund. I don't know if you have heard of her. She's very much investing in tech startups. Well, they're no longer startups, they're full-fledged companies, but they're startups who are really driving growth, and it is a little bit more volatile. The blockchain fund is a little bit volatile. And because people here in Kenya are really into sports betting, we actually have a jackpot fund that actually invests in betting companies. So that's how you would add a little bit more spice to your portfolio if you'd like. But essentially, that's how I would look at starting out. 3 funds. And then if you really are passionate about one particular other fund, I'd take it up to 4. So in terms of the next steps, all you need to do is, so somebody's asked what's the next steps. You just need to go to our website, which is ndovu.co. I've just put it on I did a direct message. Let me do it to everyone. I would just go onto the website. You can see here, there's a sign up button. You can either download our apps. They're both on the iOS and the Android. Again, it's the same user journey. You either sign up, it's super simple. And what it's logged me in, but what we would recommend is very much just follow the journey. It's meant to be like a super easy user journey. If something doesn't make sense, please do let me know, and we would love to change it, because we want to make the whole product very easy to use for everyone. So just drop us a line at support@ndovu.co. Someone's asked, can I invest using a company? The answer is yes. But the way it works is you would invest. So you would invest when you sign up. Okay, so let me just log out one moment. When you sign up, you would sign up using your first name would be the company, but then you'd have care of an individual. So it's like a nominee. According to the CMA, that's the best way to do it. So you would have the company name and then your personal name. So when you do the KYC, which is in let me show you, there's a whole KYC section, of course, because we're dealing with money. You would actually put in the nominee's details. Let me see, investor information. Here we go. Well, you can see some of my stuff, but I won't go next because there might be my documents and stuff. But this is essentially you fill it in under your personal details, and there will be a section for you to actually upload your company's CR12 form. Again, this is just required by the regulator. Do you take cash? No, unfortunately, we cannot take cash. We have any anti-money laundering rules and regulations we need to abide by, so we don't take cash. So yeah, there is a referral code that you can use. And actually I'll create it. Sorry. So I didn't actually create it for this. So just separately, if you really enjoyed this session and you'd like to bring it to your company. So we've got a whole bunch of companies that have signed up. We do a different webinar actually, where we actually take you through financial planning as a whole topic and also investing. But then we offer you a referral code as part of coming through your corporate. So we have got about 30 corporates signed up now, 29, I think, to be precise. And we then offer you a referral code. So I will liaise with Violet. I need to set it up internally first, and then she can circulate it to the group. Okay, great question, Jerry. Jerry's asking about what are taxes on returns? So because we know our users super busy, and the reason that we're investing through ETFs and including local mutual funds, what happens is the beauty about ETFs is that taxes are paid before returns are paid out. So it reduces the level of paperwork on your end that you have to fill. Now, KRA and a lot of tax governments do say that you need to report your capital gains. We don't give tax advice on that, but essentially, our thought really is our thought really is it's up to you whether you would like to report your capital gains to KRA or any other country that you might be domiciled in. But to be fair, the taxes have been paid before your returns have been paid out.
Any other question?
Sure.
Hello, I would like to ask a question on the premium plan. Do you charge any amount or anyone taking the premium services?
So there is a sign up plan of 2,500 shillings. So when you first sign up, we take a fee of 2,500 shillings, and then that gives you access to the premium.
Okay, thank you.
Thanks.
I'm going to give us 2 more minutes, and if there's no question after that, I'll just do the vote of thanks and then we'll do discussion. 1 minute actually.
And whilst we wait, I guess, there's one in the chat. Oh, share that. So someone's asking to share the recording.
Yeah, we'll do that.
Yeah. And then again, if you have any questions or something might pop up after this call, just feel free. I'll put the email address in. So if you sign up, we have a chat thing that you can click on, but you can always email us here and we will come back to you within 24 hours.
Okay. I don't think there's any other questions, so I'm just going to close this. And thank you so much, Shakita, for coming through, and thank you all of you for making time to come for this session. I hope it has been helpful, and I hope that going forward you're more confident in investing in stocks and gold. So I'll end it here. Thank you so much, and have a good day. Bye.
Thank you all.